this setup, price moved from the low of the day to the high of the previous day. This setup, price moved from the high of the day to the low of the day. In this setup, price moved from the low of the day to the high of the day and further back to the high of the week. In this setup, price moved from the high of the day back to the low of the previous day. In this setup, price moved from high of the day to the low of the day. So what is the one signal for identifying these setups that are explosive and move quite a large distance? In this video, we will look at that specific signal. If you're new to the channel, subscribe. I have a free mentorship program teaching this same strategy. Link will be in the description. Let's jump into the video. First things first, let's organize this strategy so that we can see what stands out, what pops out, and that is the one thing that we should be really focused on when identifying setups. Number one is time. So in all of these setups that I've showed you, the trades occurred at a very, very specific time. So this brings us to our timing window. Our timing window in Asia is 8 to 11 p.m. New York time. And then London session begins from 2 to 5 a.m. and then New York session is 8 to 11 a.m. All this is in New York time. Asia, London, and New York. There is a reason why we trade these times, and it's because this is when we have the most volume per session. Now that we understand the timing window, we move on to the next step, which is identifying where is the money. Liquidity is at the high and at the low. Now, at the high and the low of what? Number one, in my opinion, the place where we have the most liquidity is the high and the low of the week. And then we move on to high of inside. So this is high and low of inside days. And then number three is previous days high and low. These are the main areas where we have a lot of liquidity, and price has the potential of moving away from these levels once the liquidity has been cleared. The next thing is understanding liquidity sweeps. By liquidity sweeps, we can call them stop hunts or whatever. So let's call it a stop hunt stroke liquidity sweep. So what exactly is this? So I'm sure some of you have gotten into trades at the high, and then price comes back, stops you out, and then moves in the direction of your trade. That is what we call a stop hunt or a liquidity sweep. And this is what I have noticed from patterns over the years I've been trading. Number one is that we have pins. So if I have a pin, and most people try to trade off of pins. So when I see a pin at the high like that, I know price has a high likelihood of coming back to that level. So what do? A pin to me is an extension of the high. So I extend the high to that pin. And then I am waiting for what we call a breakout. So a one candle breakout. Not two, not three, just one candle breakout. And then the next candle is going down like that. Once I see this at the high of the week, the previous day's high or low, or an inside day, then I know we have a high likelihood of going back to take the liquidity at the low. And this is my basic, and this is basically the strategy. Wait for price to come back to a level where we have a lot of liquidity, grab that liquidity, ride that move down to the next level where we have our liquidity. Once we grab that liquidity, get out and look for the same setup another day. Just a side note, if you're getting value from this video, like the video because it helps with the algorithm and reaches many traders who would love this type of content. Back to what we were talking about. How does all this connect? Let's look at a couple of examples. So we have US 30, and this was on 17th of January, so you can actually go back test it yourself. Monday sets the high of the week, Tuesday expands it, and then Wednesday we have this failed breakout. Now once you have a failed breakout at the low of the week, we obviously know the next day we are going to buy. So I am looking for an opportunity to buy. Now we also have now the low of the week down on Wednesday like that. So on this trading day, what I am looking for is an opportunity to buy at the low of the day. Now the low of the day, price came back to that level in our timing window from 8 to 11. Now if we look at this setup, we got the breakout at 9:30, and this is what I want to see, a breakout. And I'm oversimplifying this strategy. Once you see a breakout and then look at what the breakout does, it triggers the low of the week. So this is where we have our liquidities. This is where we have the money. Once we trigger the money, we have the explosive move down, and then the next candle starts going back and buying. Then that is the entry for the move up. And actually this move went back to the high of the week. So if I had held it for 2 days, this was an opportunity to go back to the high of the week. Let's look at the next example, the Aussie dollar. Now if we look at the Aussie dollar on Wednesday, this is what happened. So we have Monday setting the high of the week like that, and then we have the low of the week like that. Now we did have this failed breakout, but when we come back to the high of the week, then things change, and because we are targeting the high of the week. Now at the high of the week, we have our timing window from 8 to 11. Look at what happened. So the first hour sets the high and the low of the session like that. But we have already triggered the liquidity because this is where we have the money at the high of the week. Once we have the high of the session, which is also the high of the day and the high of the week set in place, at 9:30 and 9:15, boom, we have that explosive breakout, and then the next candle comes back in. That is your entry to target. So your stops just above the high, and then you are targeting the low of the day. The next example is USD JPY. So if we look at the signal days, we have a failed breakout on Friday as the week is closing, and then once you have this failed breakout, Monday sets the high and the low of the week. Now once we have the high and the low of the week of the new week, this is a place where we have liquidity, but also we have liquidity at this high here and at the high of the day. Now what happens? Price on Monday, we have no trade setup. On Tuesday in the Asian session, we have, so let's look at the timing window between 8, so that's 20 to 23. This is when we have the explosive move to the high of the day, but also the high of the previous day. And we also trigger the session highs in the New York session on Friday. So all this money, where is it going to be dumped? We went down back to the low of the previous day. Just another example still on the USD JPY. We have the high and the low of an inside day. So this was a trade on Thursday last week. And if you look at this inside day, so an inside day is just a day when we have not triggered the high or the low of the previous day's high. Now, we have liquidity. This is where we have the liquidity. What happens in the New York or in the London session between 2 and 5? This is when we have that explosive move back to where we have the money, and the money is at the high of the day and the previous day's high, which is the inside day. We have the explosive move, and then boom, the next candle is our entry ride for the move back to the low of the day. These are the type of trades that I am focused on identifying.